This conference will now be
First things
recorded.
first. I almost forgot to start recording, so thankfully I just remembered. um, yeah, that's a good question. This year has so far exceeded every expectation that I set for the year. I did not expect. I thought perhaps later, maybe this summer or into the fall, closer to winter, like way down the line. I thought once we got closer to tightening and lowering interest rates, I thought it might be more conducive of an environment. But of course, the market just kind of has a mind of its own, and you have to adapt quick. The first couple weeks of the year were kind of slow for me personally. There was plenty of opportunity, and I just kind of fumbled the bag on a lot of trades. But over the last, I'd say like 6 weeks or so, I feel like I've been able to squeeze a lot out of the setups that I've been presenting. So yeah, it's exceeded expectations, and of course I still have high expectations for the rest of the year as far as the market, but I'm sticking to my guns. I still think that this market needs to digest at some point, and that'll be good. It'll set things back up, and then we do it all again. Hopefully, a few months down the road. So I have a question in the Discord from JVS, and he asked, "How do you choose your strikes, Greeks, chart levels?" And then actually it's a couple questions. So how do you choose your strikes is the first question. Second question, when waiting for move in weeklies, some of your risk you lay out could have options down 50, 60, 70%, which I assume you roll into the next week. Do you choose a closer strike at that point or keep the same strike with further expiration? And the third question is, if most of your plays are weekly, then do you add heavy mostly on a breakout level? If so, how long are you typically holding for? So I I understand that there's definitely a lot of questions around my approach to trading, specifically with how I trade options. And I'll get to the question in a moment, but I do want to preface the question just by saying that my approach with options trading is extremely, for lack of a better way of saying it, it's not how options instrument is designed to be used. So options are designed, the purpose of options is to hedge your long or short position. And the way I use options is more or less just to kind of trade a micro portion of what common stock would otherwise be. So I'm more or less I'm exploiting what options are designed to be used for. And so my approach with options it's constantly changing, and every setup is different too. There's certain setups that I treat more so with that intrinsic style approach where I'm scaling in with something that's in the money and closer to that intrinsic value, and therefore I don't need to worry about the Greeks as much. Then there's certain setups like AMD, for instance, last week when we got closer to that breakout spot. And this is more so a situation where I am going to take some out of the money contracts expiring end of week. I get a little more aggressive as I get a little more aggressive in my strike date and the specific strike that I'm choosing if we get closer to a breakout spot. So there's a
What
lot
am I
of,
doing? Shoot,
hey Paulo, do me a favor,
sorry,
brother.
sorry.
No, you're good. You're good.
So
If you
I
could
thought I
just
was
mute,
muted, man. My bad.
you're good, bro. You're good. um, what was I saying? So as as a stock, again, just looking at a common stock, not ignoring option completely. As we get closer to a breakout level, that's when I start to get a little more aggressive with the expiration and the strike that I'm choosing. So I want to go back to the question because I don't want to go too far off from what the question originally was. So when waiting for a move in weekly, some of your risk you lay out could have options down 50, 60, 70%, which I assume you roll in the next week. So again, my approach, my risk level, my risk tolerance with a lot of these charts that I'm trading and building positions around, it's important to remember that I very rarely, so let's just say I want $10,000. I'll use a whole number, $10,000. I look at this setup and I'm like, okay, I'm comfortable with a $10,000 position at max size. That doesn't mean that I'm instantly getting the full 100% size right away. I'd say typically I'm looking for somewhere in that 5 to 20% of my size as the chart's still kind of figuring itself out. So kind of in this range here, right? But pre-breakout, why things are still kind of channeled up and chopping back and forth, and there'll be a thrust upwards, there'll be a pullback, etc. I make sure to only have 5 to 25% of the max size that I want. And with that size, I am extremely comfortable if the position goes down 30, 40, 50%. I just kind of view it as part of doing business. It's part of how I approach these setups. It's just kind of nature of the beast. If I end up taking a loss in the range of 70%, 80% of that smaller percentage, then I'm okay with it, especially if the stock is still setting up, right? And as we approach these breakout levels, that's when I get more into the 50, 60, 70% of the size. And then once that trend is established post breakout, that's when I'm comfortable topping off that position. So again, it's incredibly important to remember that the aggression isn't warranted until there's a breakout and really confirmation of that breakout. That's really the take home message here. A lot of the setups that I present are going to be, I try my best to time the setups, but I also very much like to scale in and let these charts build. And so more or less my swing trade is just that skin in the game, quote unquote, skin in the game type of size, where I'm comfortable if that skin in the game position goes down and I have to cut it, but I'm not going to really get aggressive or too heavy too quickly. Edge asks, but can you have time decay on these if they are too close to expiration? So how many days of chop do you allow before you start scaling in? If it's a setup that I like, then I'm always going to try to get skin in the game right away. So I'm trying to think. So here's a great example. Yesterday on Microsoft, great example. Yesterday had that sharp pullback. And excuse me, I'm going to take a sip of water real fast. So my game plan from a couple nights ago was that I liked the setup. I liked if this held that 405 to low 400 area, I thought it could build off of that spot. So yesterday morning, when the stock was around probably 409, 408, I scaled in that skin in the game type of size. So again, using that whole number, let's say 10,000. I probably bought 10 to 20%. And it just kept pulling back and pulling back. And I ended up cutting it for a loss just because broad market still felt pretty choppy. The broad market just wasn't really cooperating. So that was just one of those examples where I had the skin in the game and it quickly approached the risk that I had outlined. So I just ditched it, right? What to you is confirmation of a breakout? Confirmation of a breakout, I'll just show you. It's better this way to just kind of go back. We'll go back a couple days. So AMD, we see the daily chart, right? We had this multi-week consolidation, this tight pattern, and we broke that. The 185 level was what I was talking about for weeks. That's the spot to watch, right? 185, that's the breakout spot. So I'm flipping over here. This is a 15-minute time frame chart versus the last chart, which is a daily time frame. So on the 15-minute time frame, I'll draw a box here. This is the intraday of the day of the breakout, right? That morning, we had the gap up. It quickly broke through within the first like hour or 2 hours. It broke through that 185 spot. It got as high as 188. And then we saw this pullback. And this pullback here was where I had my eyes on. This is what I would define as confirmation of a breakout. This is textbook A+ example of confirmation of a breakout. We broke out, we pulled back, we dipped below the breakout level. As you can see, 186 here. We dipped as low as 184, and then it rebounded and made new highs. That is textbook example of a confirmation of a breakout. Intraday, smaller time frame. So again, this is a 15-minute time frame. Intraday, pullback, and then retest high and breakthrough high. So guess what? This spot right here is where I'm topping off my position. That's where I'm getting more aggressive into a breakout setup. So at this point, these first, couple hours of the day, I probably have 50 to maybe 70% of that max size that I look for. And then once we get that pullback, and then once we get that confirmation, which is very clearly indicated within this box here, that confirmation, pullback, retest high, breakthrough high, that's when I get a little more aggressive, especially on a chart as magnificent as what AMD's chart was presenting for us, right? You've got a daily breakout above that major level, and you've got intraday confirmation. That's textbook right there. So hopefully that sort of clears up a little bit. Again, a lot of the setups that I'm posting about, just keep in mind that I'm really not taking more than that 5 to 25, maybe 30% of full position size before this confirmation. I can go to a more distant but still relatively recent example of that. I'm trying to think of, so this was a good example, Path, from a couple weeks back. This was something that I was talking about for several weeks leading up. And so in this range, this was just kind of the chop range, right? This was the range where, okay, I'm keeping it on my watch. I'm keeping it on my watch list. I'm keeping skin in the game because at any day I anticipated this move, right? This move where it went from 23 to 28 over the couple day period. I was anticipating this move taking place at any point during this chop. So I want skin in the game, 5, 10, 20, 25% of that max position size. And again, there was many times within this chop where I probably had to sell that skin in the game for a loss. And I'm just kind of more or less selling for a loss, adding back a little bit here and there. And it's manageable. That another key takeaway is that it's a manageable size and the losses are manageable. It's not building up. It's not anything that's going to defeat me or make me think, oh man, like I'm down and out. No. It's small size and I'm very patient. And then on this candle here, when we broke above this range, that's when I added a little bit. So let's say again, I'm in that 5 to 25%. This specific candle here where we poked our head above that channel, I probably got closer to 50, maybe 70%. And then the next morning, I was looking for any kind of trend. I was looking for any kind of dip within the broad trend to top off that position. And again, another thing with that is that there's often times where I'm not able to get to that max size. So, I'm using the percentages, 25, 30, 70, 100%. Sometimes I am never able to get to that 100%. And again, that's just kind of nature of the beast. That's also just kind of me respecting the chart data, because sometimes it just gets away, right? Sometimes these charts just get away from you, and it is what it is. But yeah, for the most part, that's how I'm kind of managing. Pre-breakout, it's a small, manageable, skin in the game type of size, and that's really my core. And I'd say half of that's typically going to be something end of week, and the other half of that's probably going to be 1 week out. Depending on the setup, it could be as far as a month, maybe 2 months out. A good example of a current setup. So here's a current setup where, again, same approach, same strategy that I've been talking about the last 15 minutes, hood. And again, I was very much implementing a similar strategy a couple weeks ago, right? We had this big gap up, immediately put it on watch. I said, I want to see a few days sideways. I want to see a little bit of consolidation, digestion, and it did just that. So I get my skin in the game the next day. It chops a little bit sideways. And then on this candle here, as we approach the breakout spot, that's when I kind of get closer to that 50, 60, 70%. And then on the breakout candle, I'm looking for a dip within the broad trend to top off that position. And so currently, as I mentioned last evening, we have a very similar setup developing. And with this setup, again, it's something that I am taking some end of this week. I'm considerably less aggressive with end of week positions, just because, again, the Greeks are way more aggressive. And if the trade's wrong, you're going to lose much more, much quicker. So I try not to get overly aggressive in something end of week. But this is something where I've got end of this week, I've got 2 weeks out, and I've got a month out. And so as this continues to just digest in this channel, and I can even visualize this, I think I mentioned it last night, I can even visualize this dipping as low as this, back testing this 14 and a half, maybe even 14 area. I can see it back testing as low as this area. So again, it's super important for the way I approach these trades, just not getting too much size too quick. I know this is a good enough setup that I want some skin in the game for end of week, and I want some skin in the game for something further out, but I refuse to get too much too quick. So where's the breakout spot here? It's going to be right at the recent high, right above 17, a hair above 17. This is where I would start getting closer to that 50%, 60% of that position size. With options, do you take weeklies in addition to monthlies? Yeah, I think I just covered that, Edge. Hopefully I covered that. Zivu said, do you take the same strikes at those different time frames? Do you take the same at those different time frames? If you could do me a favor and just elaborate a little bit, maybe I'm misunderstanding. I would love to answer your question, but I think I'm just slightly misunderstanding. Do you ever like to look at the option price chart? No. The chart of the options contract is essentially meaningless. So I never look at the charts within the options chain. In the chat room, Jay Fowler asks, question above might cover some of this, but question is on trade management and what your approach / thought process on adding to winners. Adding to winners is definitely thing I do, but I only add to winners if I have taken profit. Name of the game is taking profit. That's first and foremost. If you've got a green trade, your priority should be taking money off the table, should be paying yourself, right? This is my livelihood. This is how I make a living. This is how I earn money. So from very early on, this is something I embedded within my strategy, the foundation of my trading years and years ago when I first got started back in 2013, 2014. And you could even argue I was way too conservative, but it's probably better to be conservative than it is to be a little more relaxed and end up letting a winner turn into a loser. So priority is always on taking profits. And then if trend is still holding, and if you've got that pullback strength, again, textbook example, pullback strength, this is what I'm looking for, something like that. Broad breakout, broad trend in a breakout, and you've got intraday pullbacks that retest and make higher highs. That's a winner that I would add to, but again, only if I've trimmed some profits at that point. Max Power asked, I'm curious about your process. How often do you scan for new opportunities? How often do you go through every stock in all of your lists? How closely do you watch the intraday action? I scan every single day. I'd say half of what I'm scanning comes from sifting through my watch lists. I've got uh, at a rough number, probably 50 plus watch lists. They they cover stuff like meme stocks. That's a watch list, right? I've got AI stocks. That's a watch list. I've got quantum computing stocks. That's its own watch list. Technology stocks, its own watch list. Psychedelic mushroom stocks, its own watch list. So every day I'll go through these watch lists at the minimum one time and just kind of, I have more or less a memory of what the chart looks like based on what the current price is. So I don't need to pull up the charts. Really, all I need to do is go through the watch list and see what the price is, and I can kind of visualize what the chart looks like from both a daily time frame and further out back toward like a year, maybe even 2 years. So that's one way I do it. And then, of course, I use my own scans on stock charts that I've pre-programmed with different um, criteria that I'm looking for in my setups. And then how closely do I watch the intraday action? I watch intraday action very closely, especially broad market. I'm always peeking broad market. I'm always paying attention to the leaders as well. So like Nvidia's been a leader this entire year. So whether or not I'm trading Nvidia, it doesn't matter. Nvidia is always at the top of my watch list just because I know that there's so much interest and so much is running through Nvidia right now. If Nvidia has a pullback in the range of 5%, then you bet your bottom dollar that most stocks are probably going to have even worse effect, right? So head of the snake, I'm always paying attention to, and broad market intraday action, of course, always paying attention to. Chuck asked, how do you normally manage swing position after you accumulate near full size with stocks and validate levels next few days? For example, I've swung PLTR and sized up on February 29th before it closed above 25. The next few days, it gapped down and sold below 24. I reduced size on the way down and took loss below 24. Then it gapped up above 25 today and sold down below 25, got me out of my position again, and it ripped back up. My confidence got hit because of drawdown on the smaller option account and afraid to add back contracts after multiple stop outs. Yeah, Chuck. So part of that, again, I'm not gonna speak for you, but it's entirely possible that the position size was in that category of too much too soon, right? So like PLTR is a very clean looking chart in my eyes. I believe there's some audio coming from someone. Could everybody just do me a favor real fast and just double check, make sure that you're muted? Um,
I think it's the folks on their cell phones calling in on a phone number.
okay. Well, yeah. But if you could just everybody just do me a favor and just double check you're muted, I'd really appreciate that. Thanks, guys. Um, but yeah, PLTR had very clear resistance, right above 25, right in that upper 25 area, right? We tagged it here a few times several weeks back, got rejected, pulled back, right? More chop, 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 retested here a couple days ago, rejected again. This morning, we gapped above it, and it was just a wonky candle. This is a candle that I have called many times a punk candle. This is a classic punk candle. And there's not much you can really do about punk candles besides trust the big picture, trust your personal thesis. But yeah, this is the kind of wick that you see that can tear you up and make you lose confidence. So it's just, again, I hate using this line, but it really is just kind of nature of the beast. Stuff like this happens. You get a clean breakout like we saw this morning. We gapped above it. We pulled back. And in that pullback, you start thinking, man, like I have to respect my risk, right? Like this is now dipping. It looks weak. And then all of a sudden, an hour or two later, it completely recovers. And the candle ends up turning into a really brilliant looking candle. I mean, this closing candle, if you didn't know otherwise, this intraday action was probably clean. Everything was great. And no, that's just not reality. It was a very tough intraday. But yeah, again, it just kind of goes back to confirmation. So we had the gap up this morning. I guarantee if I pull up the intraday time frame, I'll go 2 days. So here's today. Okay. So I'm just going to kind of show you where the confirmation comes in. So here's the initial gap up, right? We get a gap up, and then that gap up is immediately sold off over the next hour or two, right? This is when you start thinking, okay, maybe I have to start cutting. Things aren't looking too hot, right? And then it slowly stair steps its way back up to highs. And so this area here is where we retest those highs. I would not be a buyer in this intraday setup until we break through this area. So that didn't come until much later in the day, 12:30, 1 o'clock. That's significantly later in the day than this early day action. But again, that's just kind of how you need to approach these sort of trades. It's tough. You can't top a position off on a gap up of this size. That's just, at least for my approach to trading, it's not wise. When you have a gap up, the best course of action is to always let the dust settle. And a chart like this, an intraday chart like this, the dust didn't settle until, let's see, 9:30, 10:30, 11:30. The dust didn't settle until almost 4 hours into the trading day. So every situation is going to be different. Mo asked, think he means same strike on your contracts that are end of week, 2 weeks out. Oh, okay. Do you take the same strikes at those different time frames? Okay, I'm sorry. I totally overthought the question. No, I'm always doing something different. I'll go back to Hood as a current example. So like Hood current price 16.5. So I've got three different options positions here. One of them being intra week, so end of this week. So that's going to be a 17 strike. 17 strike. The premiums are trading around probably 15 cents or so. And then I've got a month out being April monthlies. Those are 25. I beg your pardon. Those are $20 strike. Those are trading around 50 cents. And then I've got a position in May as well. And the May position, I would double check. but I want to say those are in 22. It actually could also be 20. It's either 20 or 22. But as I get further out, I'm typically going slightly further out of the money. Another good example would be IONQ. IONQ, I've got a $12.50 strike for April, and I've got a $15 strike for June, and I've got common share there too. So it's always going to be different as I extend the time frame. Frosty Leaf asked, in regards to parabolic short setups, SMCI, what was the tell that the short opportunity was very near? Was it these two things, or is there something that I'm missing? And then he lists out one, the 2 straight gap ups after 100, 200% run, then gapping up a third day. And then the second part is the volume on the second gap up day being more than or near the volume of the breakout day. Your timing was impeccable. I made notes of the setup in your trade thesis. The part I'm missing is the timing of it. MSTR, same thing, has 3 gap ups. Most people tried guessing the top when these were going parabolic, but you straight up just nailed the timing. Yeah, I'm gonna pull these charts up and just look at them together because it's probably gonna be easier that way. So we've got MSTR and we've got SMCI. Is this a good size, by the way? The size that I'm using. If you guys could just, okay. I try to make them as big as possible, but not overly large. So here is MSTR, here is SMCI, and I'm actually going to go back a couple days. Okay, cool. Let's do that. Let's do that. Okay. Okay. So the question, in summation, the question was, how am I timing these sort of parabolic blow-offs? How am I timing the pullback trade? It's one very extremely important part of it is not guessing the top too soon, right? This is kind of part one. There's a few things that go into this explanation. The first key thing is you're not actively shorting. You're not actively even talking skin in the game. Just nothing. You're literally just going to be observing, especially something of this magnitude. Strong sector, something that's been super hot, completely on fire. Everybody's paying attention to. Just, I wouldn't touch this thing with a 10-foot pole type of situation. I am sitting back and I'm letting it do its thing. And I would be lying to you if I said that I didn't start thinking that this could be putting in its top in this $700 range. So in this area, this is when I first start thinking, okay, if the next couple days have a smaller range candle and don't look too impressive, this could be the pullback spot. But of course, it just kept going. And then, as you mentioned in your question, one of the key components here, so first part is not guessing and certainly not putting money in and losing money along the way. You have to be mentally sharp. You have to stay on top of it. You have to watch, but from a distance, right? And then the next thing is the gap ups. The gap ups are when things start to get spicy. You see this gap here, and then we saw this gap here, right? That's a couple days of gap ups following this move, right? We're talking about a move from low 300s to almost 800, and then we're still gapping up. We're gapping up, we're closing at high of the day, and then we're gapping up and closing at the high of the day again. One candle of doing that gap up is when I start to think, okay, this is getting close. So this candle right here, this is when I start thinking to myself, okay, I'm not getting skin in the game yet, but we've got to be close. And so my thought process is, if we get one and especially if we get two more gaps, three gap ups following this type of, and I'm going to backtrack for a second. The I had a term for this recently, and I'm blanking on what I called it. I've got it in my notes somewhere, but I created a term for this type of consolidation. I think what I called it is vertical digestion. I think that's what I coined it as. Vertical digestion. So this is still moving upwards. It's not a traditional digestion. A digestion to me is something like this, right? This is a conventional digestion. It's a pullback, it's sideways, it's making some new lows, and it's just kind of chopping in a range. A vertical digestion is something that I'm looking for a lot of times intraday. I make a lot of day trades based on this vertical digestion. But a vertical digestion is when the price is continuing higher, but the range isn't really expanding and there's no real weakness. So a vertical digestion that starts gapping up afterwards is definitely on a daily time frame. Again, that's certainly when I'm paying close attention. And then the next morning we had one more gap up. And so I put it on my watch list on this evening, and I forget exactly what I said, but it was probably something in the line of, if we get one more gap up in the morning, I'm looking to get some skin in the game. I'm almost certain I forecasted a pullback in the range of 15 to 20%, something like that. And at that point, especially if this kind of candle takes place on a Friday, that's when you're talking about the big opportunity, because premiums are probably pretty cheap on something out of the money. But yeah, the main components here are not guessing the top too soon, not shorting actively, and lastly, you're waiting for those blow off candles. These are the blow off candles. These gap up candles right here, and then again, the third gap up candle. And MSTR kind of fits the criteria kind of similarly. It didn't have as clean of a look. You could more or less say that this was the vertical digestion, and then this was the gap up following that vertical digestion. And so to me, as well as the correlation with Bitcoin on this, Bitcoin was retesting all-time highs. Very similar situation. If this was going to go another day and gap up, I wanted to get some skin in the game. It didn't exactly gap up, but it did have a wick close to that high. And I did mention in the chart and in the chat the other day too that this one just wasn't as clean, but it was similar-ish in nature. But yeah, those are the key takeaways. You're patient for those blow-off candles. You're patient for that overwhelming euphoria in the markets. Yeah, there was some times here and here when things felt euphoric, right? But my gauge, my meter was just never rocking off the charts, right? I'm sure you guys have seen that meter that goes from greed to fear to greed, 0 to 100. My euphoria meter down in this area was still kind of in that 50 to 60% range. My euphoria meter started getting up toward that 70, 80% range here. And then once we got these gap ups, my euphoria meter was just at 110, right? So everything's just way too euphoric to sustain itself at that point. That's the point where, okay, I want some skin in the game now. My euphoric meter's off the charts, and a pullback's likely imminent. And I'm sorry if this explanation ran a little long. I do think it's an important it's an important question, because as much as I love describing this stuff and showing you guys what I'm seeing, it's equally as important that you guys can look at this and take it in and learn what I'm seeing. The execution of it is a different part, but being able to see what I'm seeing in this stuff is equally as important. So hopefully that explanation did some justice. Lauren and Steven asked, would love to know more about psychology behind growing an account that is 1K. My mindset currently is to take only the A grade setups you mentioned, like PLTR and Hood, but I'm wondering if it's smarter to play just equity or in the money options. For example, end of day today, I was looking to enter PLTR and was going to do 3 months out and $20 strike. Was wondering, excuse me, was wondering if you can expand on this decision making and what you recommend is the best criteria game plan to grow small accounts. Yeah. Great question. Small accounts are the backbone of foundational. It's the backbone of how to learn to trade. I traded on a $2,000 to $3,000 account for the first 2 years that I traded. And the most important things that I learned in my career from a just basic fundamental standpoint came when my account was in that $2,000 to $3,000 range. I took $2,000 to $3,000 up to $12,000. I was convinced that I was going to be a millionaire within the next couple months, and then it came crashing right back down. I turned so 2 to 3 up to 12, and then that came back down to like 1,500. And then it took me 2 years to turn that 1,500 back into 10,000. But that process from $1,500 to $10,000, that 2-year process to grow my account, whatever percentage that is, 300-400%, from a tiny account up to a 5-figure account, what I very much focused on, I said it earlier in this webinar, taking profits, that's first and foremost. If you've got a green position, let's say you've only got 2 contracts, take one of those contracts off, put that money aside. That's your take-home pay, right? So that's an incredibly important part of a small account is compounding. You can't be looking for a home run, and it's kind of boring, and it's not sexy, it's not flashy. You're not gonna retire anytime soon trading that way. But what you are going to do is you're going to set yourself up for years and years and years of success by just practicing the basic stuff, cutting losers very quickly, taking profits very quickly, and just being a student of the game, right? So I think that's really the most important thing. And you also mentioned too that the A quality setups. That's certainly something that I'm striving to enter when I've got a small account. I'm not interested in trading every single thing, right? I've got 1, 2, 3, 4, 5, 6, 7, 8, 9. I've got 12 things up on my screen right now. If I've got $1,000 account, I'm spreading myself way too thin if I'm trying to trade anything more than 2 or 3 positions. So focusing on just 1 or 2 top setups, really the name of the game. And that's not going to happen every day. There's not going to be an A quality setup every day. And this type of market, maybe over the last month or so, there's probably been an A type of setup at least every other day. But in most environments, you're just not going to find an A type of setup every single day. So you have to know when to hold them and when to fold them. That's, by the way, one of my favorite songs. You got to know when to hold them, you got to know when to fold them, you got to know when to walk away. And that's never been more applicable than it is to trading, especially with a small account. Mo asked, is there anything you look for in particular when choosing the strike / time frame, IV Greeks, etc.? Great question, Mo. Great question. This is something that I've changed. I've changed my approach with this a lot over the last several years. And that's trading. I mean, that's strategy. That's basic. That's anything in life. You have to be fluid. You have to be ever changing and evolving. And something that I've done over the last year, 2 years is I'm trying to find, here we go. With breakout trades, I'm always looking to anticipate range. And with anticipating range, I can pick a strike based on what I can visualize with that anticipated range. So I'll use AMD as a recent example. So the breakout level being 185, I'll draw that breakout level there. So what I had been visualizing with AMD was through 185, and I can see this over 190 very quickly, and I can see this thrusting upwards toward 200, maybe over 200 within a couple days. Of course, obviously, that's how it played out, but more important than that, the strikes that I'm choosing with something like this are going to be something that are out of the money, but I can anticipate them going in the money. So in this situation, I'm looking at a strike around 190, I'm looking at a strike around 195, and I'm looking at a higher end strike up toward 200, right? These premiums are going to be super cheap relative to what the anticipated range is going to be, right? Especially if the implied volatility is low, which thankfully the other week the implied volatility was still low. So the premiums on something out of the money were still extremely cheap, extremely lucrative if the setup manifested how I visualized. And so, yeah, that's in a nutshell. The core of my position is always going to be something a little less aggressive on a target. So my core position was probably in the 185s. So again, I had a position that I was scaling in and out of that were probably 180 to 185 strike. But once this got to that breakout spot, once it got close to the breakout, and certainly once it confirmed the breakout, that's when I'm really upping my size in something out of the money that I'm anticipating going well within the money. So I hope that covered that question. Brian the real Oyam said, first and foremost, thank you for opening the room publicly. Appreciate the time and effort. Someone like me sponging up all the knowledge. What type of indicators do you use when looking at charts for setups? The main indicators I use are volume and candlestick data. I don't concern myself with much other than candlestick data. Volume is an important aspect of trading, and certainly is an aspect of what I look for in trading. As we can recall, within the last couple months, ARM. I was talking about ARM most of November and December. I was talking about ARM way down in this range here, and I was constantly noting the volume, and I was constantly noting how this wasn't going to have a breakout until the volume was an anomaly. And we had this volume candle here off of this candlestick, but that just wasn't even remotely close to what I was looking for. This, on the other hand, was certainly what I was looking for. This is a volume anomaly that supports a breakout supported by volume. These are really the two indicators, the two things that I'm looking at when I'm charting and formulating theses. It's candlestick data, volume data, not anything else. And also working off Lauren and Steven's interest in best game plan criteria for growing account. How many open positions do you like to manage at a given time? It all depends. Again, for me personally, during environments like this where there's a lot going on, I might have as many as 20 open positions, but my primary focus is it's never going to be on more than 2 or 3 setups. And those 2 or 3 are kind of the main focus. That's where the main energy, the main attention, the main risk management. If I'm going to oversize or if I'm going to size up into a trade, it's never going to be in more than 1 or 2 things. And again, the smaller your account, you really, your focus needs to be on a couple things versus being everywhere at once. And the other part of this question was, how do you decide how much to put into various positions, as well as how much of your overall portfolio versus having cash available? He also outlines, thank you for explaining your entry into positions via recent post. Skin in the game equals 25 to entering 25, 33, pullback 33, topping it off. Yeah, so I've covered kind of that idea of my approach. But yeah, and again, every setup's going to be different. Not every, so actually ARM, this one right here, good example. I simply refuse to put this setup as something that I want a position in until it gets to this level. I think it's just kind of in this choppy range where I kind of learned my lesson more or less with something like AMD, where like I did, again, I was perfectly right on the thesis, but there was definitely a little bit more chop than I anticipated, and it never really came close to me burning out. But it was definitely, at times I was like, okay, I'm cutting this red position, but like it's not even close to the breakout spot. So let's just be more patient. So here I am now completely testing that approach where I refuse to get chopped up, and I'm just waiting. I'm simply just waiting. This 150 level is the only level I'm interested in. This is, again, let's say tomorrow morning this thrusts upward to 145 and approaches that 150 level. I'm probably going to get a little bit of skin in the game close to that spot, but I wouldn't look to get a real position size until it breaks through, and definitely not until it has some level of confirmation. So every setup's going to be different. Every size and every setup's going to be different. It's really just kind of how I'm feeling about the particular thesis or the broad market, but everything's going to be different. It's hard to say exactly. If you were to list out, okay, Matt, tell me how you managed PLTR, PATH, ARM. You know, if you listed out 10 tickers, I could tell you 10 different ways how I managed 10 different positions. Everything's going to be different, right? Of the charts you post, this is from Ike5, of the charts you post, what type of risk are you talking about percentage-wise if you add multiple times and then the stock goes to your risk price? Example, IONQ. When you say scale in, are you using the risk area within the money plus intrinsic for this play still? Great question. And IONQ's equally great example, because IONQ has pretty much all but breached the area of risk that I've been talking about. I think I first started mentioning this setup a couple weeks back, probably somewhere like in this range, probably somewhere here, right? And my risk was from the start, I didn't want to see this breach below this recent low. Mid 9s to low 9s was kind of the area where I wanted to see it hold up. And it has held up. And looking at it from a big picture perspective, this chart's still very much intact. But at the end of the day, it's getting to that risk threshold. So I have probably 25, 30% of that max position size, but I did trim some of it in one of my accounts today just because I would rather wait now. So off of that position that I sold today, so let's just say for simplicity's sake, I'm down to like 10% of my size. So I had 25% going into today, and I trimmed, or I think it was yesterday. Yeah, yesterday I trimmed more. So let's just say I went from 20 to 10% yesterday. At this point, I'm not interested in adding into this in any more of this position until we break this recent high. I still think that this is an incredibly constructive chart, and it can easily do something like this over the coming weeks and work its way back up. And, over the next couple months, it could work its way back up to 15 and broad, big picture perspective. But I simply will not add any more at this point until there's more of a confirmation. And this level, by the way, this isn't a breakout. So there's a distinction that needs to be made between a breakout and an inflection break in a chart. So this area I would consider to be an important inflection break, right? I'll draw this a little differently. So an inflection break is when you've got typically, let's use a longer time frame, like a daily time frame, right? You can get inflection breaks intraday, but that's an entirely different topic. So I'll just stick to daily time frame. An inflection break is going to be a higher high over something that was a resistance point a couple times over the last couple months. It's a broad reversal in the trend, right? So we had some resistance here, we had some resistance here, we had some resistance here, and I can kind of lump this area in as well. This area is a little higher of a price point, but for all intents and purposes, this is kind of the same area. So let's just call it the 12 to $12.50 area. If this broke up through this $12 to $12.50 area over the next few weeks, that would be a major inflection break. It would be a higher high. So let's just, I'll draw in some chart data, blah, 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 right here, right? This would be a major inflection break. It would be a higher high over previously tested and rejected spots that are now, okay, well, I'm looking at this chart. We're making higher high. We've cleared through what has been a resistance over the last couple months. Major inflection break. A breakout is much different. A breakout isn't until way up here, right? This is your breakout area. Another good example actually is Hood. Hood is a great example of an inflection break versus a breakout. Hood, you go back the last several years, resistance, 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 and then break. This is a major inflection break on Hood over the last couple weeks, right? And I'm almost certain I mentioned that in the write-ups that I've been providing. But this chart data that we now have over the last couple weeks is in an entirely new channel. It's in an entirely new spot of the chart that we haven't been in 2 years. Major rejection, major rejection, major rejection, and a whole bunch of chart data well below where we are now. That's why I'm so interested. I think I went off on a little tangent. I don't exactly remember what the original question was, but I'm going to transition back. I got a question here from John. Matt, so with this arm setup, clear ascending triangle to it, similar look to PLTR as far as the setup, I'd be adding on diffs with respect to the trend line and or higher lows as it approaches the breakout spot. Would you do similar? Yeah, that's certainly not a bad approach. But personally, as I said, I don't want to get chopped up in it. My primary focus at this time, besides really just hand sitting, it's been a good couple weeks for me. So I'm really just not in a rush to make trades and certainly not to size up in anything. But yeah, if I were to be scaling in right now, I think that would be a good spot. Yeah, you've got kind of this general trend, right? You've got this area of support right around 130. So again, you've got a trend line support that we followed along. You've got this horizontal support area. But like I said, I'm not really interested in it until it gets closer to 150 or over 150. I'd rather be a little bit late and undersized than get chopped up beforehand. BC asked, gut feeling is the only way the entire market tops is with some sort of extreme euphoric blow off across all asset classes like .com 2000. That's certainly one way to do it. Yeah, that's a quick way to do it. But I do think that euphoria in just an individual sector can be enough, mostly just because look at Nvidia, look at the chip stocks as a sector versus a lot of other major tech stocks. I mean, look at Nvidia's chart and then look at Apple. It's almost like opposite, right? So there's part of me that thinks, okay, if Nvidia pulls back over the next few days, does Apple just completely fall off a cliff, or does money rotate back into Apple, and does money rotate back into something like Google, which has had a downtrend over the last several weeks? So I think what you're alluding to is certainly a possibility, maybe later this year, maybe next year. I just don't think at this time that's really in the cards. I think the broad market is way too close from a risk to reward perspective. I simply just don't see much more upside within the broad market before some sort of digestion phase playing out. So I think that that's possible down the road, but just not at this time. I think it's more so a specific sector at this time. All right, I'm going to do a couple more questions. If anybody's got one or two quick ones that you want to write in the chat, I'll do one more from the Discord. ZV0000 asked, you may touch on this a bit in your answers to some of the above. I was wondering if you could suggest some of your favorite time frame indicators or anything else that you think would be a good place to build a foundation off of. Love the advice to younger self videos. I appreciate that. I love making those type of videos, and it's been way too long since I've made one, so I need to get back on that. But yeah, I think ZV0000, I think I've covered a lot of that in the discussion, but it's really just candles and volume. Moving averages play some sort of importance, but moving averages are more or less arbitrary. They're not as significant. They're kind of arbitrary levels that are just agreed upon the the stock gods, if you will. It's not real. It's kind of just fugazi type of stuff. So it's chart data and chart data with candlesticks and volume data. Can you dive into how you developed your strategy when you started? How many trials/errors do you have to go through? What/when was your turning point where it clicked and you were able to create consistent profitability? Was there a light bulb moment, or was it small steps that eventually led to it? How challenging was it to build and keep confidence? This is a question from Jay Fry. Can you dive into how you develop your strategy? So my strategy early on was I mentioned earlier, I was trading a very small account, and back then, back in 2013, 2014, the OTC market, pink sheet, micro cap penny stocks were a lot more tradable back then. There was a lot of action. So I had no interest back then trading anything even remotely close to what I trade today. I wasn't trading options. I certainly wasn't trading $500 stocks. I was looking for stocks that were trading for pennies. And believe it or not, chart data, human psychology, and how it translates into chart data is perfectly applicable as far down as you can go. As low of a price point as you can think, the same chart data is going to surface, because at the end of the day, it's all human psychology just depicted on these graphs. So as long as you've got some level of liquidity and you've got an asset that's trading, it's gonna have something similar to that. So I was trading a lot of penny stocks back then, and then once, I think it was around 2016, 2017 is when I had more of an account size where I was more comfortable trading stuff in the $1 range, $2, $3, $4, $5 range, something like that. Um, but yeah, the trial and error part of it was just a lot of barely missing out on setups. I had a real good eye for setups very early on. I'd say within the first year of my trading career, I could identify a breakout chart. I could identify a chart that was getting close to a big breakout, right? But I was just not. I was tripping over myself, and that was really the proverbial light bulb moment for me. Was more or less when I just had that first good trade. It was a couple years in. It wasn't until like spring of 2016 where I had like a multi-thousand-dollar trade that I just felt like I really nailed. And it was that first confidence building trade that I was like, okay, I can really do this. I've known I can do it, but I haven't had the success to really prove it to myself. And that's really important too. It's you just if you're new or newer into trading, you really just have to be patient for that opportunity to come where you build that confidence. And it can take a while. For me, it took, what year did I say? I think it was like early 2016. So that was like 3 years. 3 years, guys. That was 3 years of me just kind of doing little trades and missing stuff and tripping over myself, taking notes. I was learning a ton. Again, I said I had a great eye, but like psychologically, it wasn't clicking. And then all of a sudden, I had one or two confidence building trades, and then things just started clicking from there. And I was more comfortable, and I was still applying the same risk strategy, risk management, and trimming for profits and not sizing up too quickly. So yeah, the trial and error part of it's incredibly important. You have to go through it. It's not necessarily fun, but I can bet you money that anybody who makes a ton of money real quickly into their trading career, chances are very high chance that they're gonna flush all that money right back down the toilet and probably then some. So for me, I would much rather take 2, 3 years to really learn everything that would set me up for the rest of my life than make a bunch of money and then, flush it all right back down the toilet. All right, guys, if there's nothing else in the chat, then I'm probably going to wrap this thing up. Again, this is recorded, so I will upload this to YouTube and get a link, and I'll share it to chat, and it'll be digestible for all. And yeah, I plan on running these at the very minimum every other week. Format's going to be real similar. Get in chat room live or post your question in the chat. But yeah, other than that, I appreciate you guys, and I will see you all later. Have a good one, all. Take care, guys.